Hello and welcome to UAN Governmental Fund Accounting Course 102. In this video we're covering the Uniform Chart of Accounts, Chapter 1 of 4. Additional chapters in this series are Budget Basics, Cash Management, and Transactions. The book contains more detail on some of these subjects, so don't forget to read through the material as well as watching the video. Let's begin. Remember that UAN support personnel are not permitted to provide guidance for selecting items from the Uniform Chart of Accounts, except for the basic concepts presented in this video. Do not refer to the examples in this training as a resource. We are just teaching the structure, purpose, and importance of selecting the correct items. You should always refer to the most recent version of the Chart of Accounts and give the Auditor of State's Local Government Services a call when you need guidance. In Fund Accounting 101, we learned that there are three categories of funds in the Uniform Chart of Accounts: governmental, proprietary, and fiduciary. And within each of these categories are several fund types. Within the fund types, there are many choices, and to help you understand the differences, we'll discuss the categories and fund types in more depth. The governmental category contains funds that account for the typical public operations of a government entity. The category includes the general fund, which is the only unrestricted fund. Almost every entity has a general fund. The purpose of each governmental fund type is determined by the restricted revenue sources authorized by voted levies or board-adopted legislation. So your fund structure and restrictions are unique to your entity. The general fund is often an entity's most significant operating fund. Almost all entities have a general fund, and many small libraries and special districts have no other funds. This is the only unrestricted fund type, and it accounts for all transactions not posted to the restricted funds. Its revenues come from many sources. Its expenditures cover multiple functions of the entity. Special revenue funds are established in accordance with Ohio Revised Code. The revenues are restricted to particular expenditure purposes by law, contract, or agreement. Often villages and townships have more than one special revenue fund that can be used for the same purpose, such as road maintenance. Some of these funds can be used for the exact same purposes, but others may be more restricted. The book contains some excellent examples of special revenue funds, and I urge you to read this chapter in the book to learn more. Within the special revenue fund type are levies for operation, such as cemetery, fire, public park, and others. These locally voted levies are special revenue funds. The language of the levy authorizes the use of the money. Therefore, you must always look to your own entity's levy language to determine how the money can be spent. Debt service funds are only used for repayment of certain general obligation long-term debt, principal and interest. They're not used to receive or spend the loan. The loan money is received and spent through a different fund, such as a capital project. Unless there is a specific requirement, such as a contractual agreement or legislation that requires the isolation of debt repayment from other monies, debt may be paid from unrestricted monies that are segregated from restricted monies in an existing fund. Okay, well, I'm sure that made a world of sense. So the simple fact is you have to review your debt agreements and your funds and perhaps discuss the situation with local government services to determine if you must have a debt service fund or if you can pay the loans, principal, and interest payments from an existing fund. Capital project funds account for construction or purchase of major long-lived fixed assets. Resources for construction or purchase of an asset often come from loans or grants. A capital project fund exists only until the completion of the project. This fund type is for governmental type projects. If the project is financed by or for the purpose of an enterprise, internal service, or non-expendable trust fund, you select a fund within those fund types, not the governmental fund capital project type. Permanent funds account for donated resources with restricted purposes. Hey, there are strings attached to the money. The giver tells the receiver how it can be spent. But for the permanent fund type to be used, the money must support the entity's programs. It cannot be used for a private purpose. Permanent funds also must include a non-spendable balance. So if you're thinking about using the permanent fund type, but you don't have a non-spendable balance, it is not the correct choice of fund type. The most common examples are a cemetery bequest or a library endowment fund, where the interest earned can be spent on the entity's operations. Remember, permanent funds are not to be used for a private purpose. Proprietary funds account for activities similar to those of a business. They are always restricted. They're financed by charges for services or goods, and the rates are set by legislation and should cover the cost of operations. Let's explore some fund types in the proprietary category. Within the proprietary fund category are enterprise funds. Most common examples are village utilities such as water and sewer. And within the enterprise type, there are operating, capital project, debt and deposit, and other funds. So you always choose enterprise funds from an enterprise type. For example, a water capital project doesn't belong with the governmental capital project funds. It's an enterprise capital project. Internal service funds are established to account for the provision of goods and services by one entity department to another on a cost reimbursement basis. A common example is vehicle maintenance. When large entities have a fleet of vehicles, it is often more cost effective to hire one or more full-time mechanics to work on the vehicles instead of paying separate vendors. To use an internal service fund, the entity must develop a pricing system for services and then bill each internal department to finance the cost of the mechanic, parts, tools, etc. The fiduciary category contains funds that account for assets held in a trustee or agent capacity. Any revenue received is paid out to individuals, private organizations, or other governments. Establishing a formal budget is not required, and trust funds in this category may have a non-expendable balance, but may not, depending on the agreement. An agency fund type may be used by a village for their mayor's court. Fines and court costs are collected by the mayor's court during the month, and at the end of the month, 100% of the money collected is distributed to governmental agencies, including the local entity. Then the fiscal officer posts the mayor's court total activity through an agency fund, so the figures appear on the annual financial report. Another example would be an unclaimed monies fund, used by entities to hold money that has not been claimed. The unclaimed monies fund is non-expendable, and it's only used to hold the money. If a person comes forward to claim their money, the amount is transferred to the general fund and the payment is made from the general fund. Ohio Revised Code specifies the time period unclaimed money must be held, and after that period, the unclaimed money is transferred to the general fund and can be used. Private purpose trust funds belong in the trust fund type. These funds account for donated resources for private purposes. So there are strings attached to this money. The giver tells the receiver how to spend the money for a private purpose, not to support the entity operations. These funds may include a non-spendable balance, but they don't have to. They can still be donated to a cemetery, but would be used to place flowers on a particular grave, or donated to a library, but is used so organizations or individuals benefit from the spendable amount rather than the library operations. The purpose determines the correct fund type, and these funds are private purpose. Some funds are permitted to receive interest, others are not. The Uniform Chart of Accounts fund list clearly indicates which funds are permitted to keep their interest, which funds are not permitted to keep their interest, and which funds may keep their interest under certain conditions. There is more information in the book. Read this section carefully to make sure you understand the law and your funds. If a fund is not permitted to retain its earned interest, the general fund receives the distribution. There are no exceptions. We'll cover more on this subject in Chapter 4. Now you understand the structure of the Uniform Chart of Accounts and how funds are categorized and restricted. You need to know when you are permitted to add a new fund. Let's use a silly example. A governing board meets and someone makes a motion to add a daisy fund. They're going to transfer $5,000 from the general fund to the daisy fund, and then they'll always have money to plant daisies. They're going to be the most beautiful entity in the state. And then the fiscal officer scratches her head and says, wait a minute, isn't there a procedure to follow? Can they just vote to add that new fund anytime they want? And that's a very good question. So let me set you on the right path. There are rules to follow when the board wants to add a new fund, and we want you to follow them. When an entity needs to establish a new fund that is already authorized under Ohio Revised Code 5709.09 or Revised Code 5705.13, Sections 131 and 132, the governing board must adopt legislation to establish that new fund. And then the fiscal officer can add the new fund and add the revenue and appropriation accounts that belong to the fund. But when an entity wants to establish a new fund that is not authorized by statute, like our daisy fund example, or when the purpose of the fund is not identified in Ohio Revised Code 5705.09 A through H, it's then necessary to adopt legislation requesting approval to establish the fund and send a copy to the Auditor of State's office with the Auditor of State Request for Fund Approval form through the local government services office. If approved, the governing board must adopt legislation to establish the new fund. Then the fiscal officer can add the new fund and add the revenue and appropriation accounts that belong to the fund. A new fund is justified when it will provide additional relevant financial information not obtainable using the current fund structure, and it's necessary to demonstrate compliance with legal or contractual restrictions. However, if you don't seek the proper approval, the next audit will typically require removal of the fund. So always follow the correct procedures. So the daisy fund is not going to meet the requirements. In this silly example, you would have to reallocate all the expenditures and move the money back to the general fund. Let's talk about revenue accounts. You learned about revenue accounts in Course 101. Some of the basic points were revenue codes vary by entity type. Revenue codes are used to properly classify receipts on the annual financial report. A revenue account begins with a fund number and is followed by a 3-digit revenue code. Revenue codes must be selected from the correct revenue type. And remember, that is the most common mistake. And then all receipts are allocated to revenue accounts. Some of the puzzling questions about revenue accounts can be easily resolved by understanding the following. Revenue accounts aren't vendor specific. If you receive the same revenue from 2 different vendors, it posts to the same revenue account. For example, 2 cable companies pay cable franchise fees. They both post to the same revenue account. Different revenue may use the same revenue account. This is a common mistake. Let's use a township example first. Many townships have cemeteries and they have different fees charged for things like open and close, grass seed, sod or resodding. These are all fees. They post to the same revenue account. However, grave sales are not fees. Sales would use a different account and all of the fees would post to one other account. In a village example, let's use a swimming pool. There may be swimming pool charges for daily admissions, swimming lessons, and pool parties. These are different fees, but they are posted to the same revenue account. However, concession revenue is not a fee. It would use a different account. Different funds may have the same revenue code. So remember that all funds that receive interest are going to have an interest revenue code. All funds that receive real estate tax distribution have the same set of revenue codes. Each fund uses the revenue codes that represent the revenue it receives. A receipt can be allocated to multiple revenue codes. The county auditor, for example, sends a check that includes local government and cigarette tax distributions. One receipt from the county auditor is posted for the full amount, and each type of revenue is allocated to its proper revenue account. When you receive money that doesn't fit into the revenue accounts you already have, you must review the Uniform Chart of Accounts for the revenue codes and add the new code to the fund, and then you can post the receipt to the new revenue account. Now that might sound simple, but that is often a problem. You learned an awful lot about appropriation accounts in Course 101 too. Some of those basic points where the Uniform Chart of Account, appropriation, and program codes vary by entity type, you have to use the correct Uniform Chart of Accounts. Appropriation program and object codes are used to classify expenditures for proper annual financial reporting. Appropriation accounts are made up of fund number plus a program code and an object code. Program codes represent a service area. Object codes represent the purpose of the expenditure. Appropriation program and object codes must be selected from the correct type. This is a very common mistake. And all expenditures must be allocated to the appropriation accounts. You can use multiple accounts on a payment. We have more ground to cover with appropriation accounts, so let's get started. Appropriation object codes have 3 levels: summary, subsummary, and detail. Each entity determines the level of object codes they want to utilize within each object group. Detail codes may be very useful for cash management and budgeting on a day-to-day basis. However, this level of detail does not appear on the annual financial reports. They're consolidated up to the highest summary code. So let me show you what I mean by looking at a section of the chart of accounts. This is an excerpt from the 300 range of object codes for all 3 entity types. You should look at your entity type on the screen. The 300 range is either called purchased services, contractual services, or purchased and contracted services, depending on your entity type. They all mean the same thing. You pay a vendor for services provided. Within the 300 range, there are many sub-summaries for different types of services. The sub-summary on the screen is utilities. Notice beneath the sub-summary utilities account, you see detail accounts for electricity, water and sewer, and natural gas. There are more in this range, but we only need to see a few. You can choose to budget all of your utilities together on one sub-summary account, utilities, or you can choose to use the detail accounts for each utility, such as electricity, natural gas. Large entities find the detail useful for budgeting fixed costs on an expanded level. Sometimes smaller entities with very tight budgets would find the detail level cumbersome because it's difficult to spread a small budget this thin. At each sub-summary level, you can determine if you want detail accounts, but you cannot mix the 2 types in the same sub-summary range. So what does that mean? Well, in the sample on the screen, if I select electricity and natural gas detail accounts, I cannot choose the sub-summary account utilities. I either choose detail or sub-summary. So keep in mind that just because you choose detail in one area, like utilities, doesn't require you to use all detail accounts in the rest of your appropriation accounts. You simply can't mix the types within the same sub-summary range. Appropriation object codes also have 2 expenditure types: direct and non-direct. The Uniform Chart of Accounts Appropriation Object Codes define the status of an account. Direct accounts do not require purchase orders. Therefore, expenditures may post directly against their appropriation budgets. Direct accounts are primarily wage-related, but there are a few others. Non-direct accounts require purchase orders to encumber the budget before purchases are made. Expenditures are then posted against the purchase orders. You cannot change the status of an account. You must choose the correct account and use it as required. If you're a new UAN customer, you may have difficulty converting your old accounts to the Uniform Chart of Accounts structure. Accurate program and object selection is essential to success. Your old accounts may need to be combined in the Uniform Chart of Accounts. We sometimes see new UAN clients using separate appropriation accounts for employees or vendors. For example, James, Suzanne, and Trina all work in the same department and are paid from the same fund. But in our current system, they have different accounts. So when converting to the Uniform Chart of Accounts, they all belong to the same fund, program, and object codes. What'll I do? Well, you're going to use one appropriation account with the fund, program, and object code that will filter the expenditures to the proper place on the annual financial report. You generate reports that show who was paid from what appropriation account. You don't use appropriation accounts to improperly separate employees or vendors. So don't pick improper programs and object codes just to retain your old structure when it isn't accurate. And remember, don't use cost centers to get around using the correct codes in the Uniform Chart of Accounts. Remember, those codes filter expenditures to the proper position on the annual financial report. Convert accurately to the Uniform Chart of Accounts to build the correct foundation for your annual financial report. You and your governing board will quickly learn the new accounts. Formalizing account and budget changes may require board-adopted legislation. Let's review what you've learned in Chapter 1. Fund categories, types, and procedures for adding a new fund. Helpful hints for posting receipts to revenue accounts. Appropriation Object Code has a summary, subsummary, and detail level, and appropriation object codes establish the direct or non-direct nature of an appropriation account. This concludes Chapter 1 of UAN Governmental Fund Accounting 102.